Depositing $9,900 in cash can trigger more scrutiny than depositing $11,000. A growing number of retirees across the United States are discovering an uncomfortable truth about their banking habits. Financial experts and federal investigators confirm that depositing $9,900 in cash can trigger more scrutiny than depositing $11,000. This counterintuitive reality stems from federal banking regulations that millions of Americans fundamentally misunderstand. Banking industry analysts report that this misunderstanding has led countless law-abiding citizens into unnecessary legal complications. The phenomenon affects seniors disproportionately, according to financial advisors who specialize in retirement planning. Understanding how federal cash reporting actually functions has become essential knowledge for anyone managing significant sums of money during their retirement years. Federal law mandates that financial institutions file currency transaction reports whenever customers deposit cash exceeding $10,000. This requirement applies universally across all American banks and credit unions. The filing process operates automatically through computerized systems. Bank employees exercise no discretion over whether reports get submitted. The law simply requires documentation of large cash movements. Investigators emphasize that these reports carry no accusatory weight. Currency transaction reports do not constitute investigations or audits. They function purely as records documenting that substantial cash transactions occurred. Financial crime enforcement agencies receive millions of these reports annually. The overwhelming majority generate no follow-up action whatsoever. These documents remain dormant in federal databases unless broader investigations connect them to suspected criminal activity. Depositing $11,000 in cash remains entirely legal under federal law. The transaction triggers automatic reporting, but reporting itself creates no legal liability. Millions of Americans complete such deposits every year without consequence. The cash moves into their accounts, paperwork gets filed electronically, and life continues normally. The critical distinction that catches retirees off guard involves a federal offense called structuring. This crime occurs when individuals deliberately divide cash transactions into smaller amounts, specifically to circumvent reporting thresholds. Federal prosecutors confirm that structuring constitutes an independent criminal offense, regardless of whether the underlying funds are legitimate. This legal reality surprises most Americans who encounter it. Someone selling a family vehicle for $12,000 commits no crime by depositing that cash. However, that same person commits a federal offense by deliberately splitting the deposit into smaller amounts to avoid generating a currency transaction report. The money remains legal. The method of depositing it becomes criminal. Banking compliance officers report that their monitoring systems specifically target patterns suggesting structuring activity. Modern financial surveillance software analyzes customer behavior over extended periods. A single deposit of $9,900 attracts minimal attention. However, repeated deposits at similar amounts just below the reporting threshold activate automated alerts. Consider the pattern that raises immediate concerns among bank compliance departments. A customer deposits $9,800 on Monday. The following week, another deposit of $9,500 appears. Several days later, a third deposit of $8,700 posts to the account. Banking software identifies this sequence as potentially deliberate threshold avoidance. The system response differs dramatically from standard currency transaction report filing. Banks detecting suspected structuring submit suspicious activity reports to federal authorities. These documents carry fundamentally different implications than routine transaction reports. Suspicious activity reports indicate that financial institutions believe customers may be attempting to evade federal reporting requirements. Retirement planning specialists confirm that seniors frequently become entangled in structuring allegations despite having no criminal intent. The problem traces to widespread misinformation circulating through communities and families. A persistent myth suggests that keeping deposits below $10,000 prevents government tracking of personal finances. This advice sounds logical to those unfamiliar with federal banking regulations. Avoiding the reporting threshold appears to offer privacy protection. In practice, however, following this guidance creates exactly the legal exposure that retirees hoped to avoid. Financial crimes investigators describe a typical scenario they encounter regularly. A retired couple sells a recreational vehicle through a private sale. The buyer pays $13,000 in cash. A well-meaning family member advises splitting the deposit to avoid federal reporting. The couple deposits $6,500 at their bank, then returns several days later with the remaining funds. From the retiree's perspective, they exercised reasonable caution. From the bank's automated monitoring perspective, the pattern matches known structuring behavior. The system flags the activity. Compliance officers review the account. A suspicious activity report gets filed with federal authorities. Compare this outcome to simply depositing the entire $13,000 at once. Yes, a currency transaction report automatically generates. That report documents a legitimate cash transaction. No suspicion attaches to the activity. The deposit appears routine because it is routine. Banking industry veterans confirm that transparency consistently produces better outcomes than perceived cleverness. Large cash deposits with clear documentation create minimal concern. Patterns suggesting deliberate threshold avoidance generate sustained scrutiny. Retirement financial advisors identify 3 situations where seniors most commonly encounter these issues. Understanding each scenario helps retirees navigate cash transactions appropriately. Property sales represent the most frequent source of large cash deposits among retirees. Vehicles, boats, land parcels, and recreational equipment often sell through private transactions. Buyers frequently prefer paying cash. When sale prices exceed $10,000, proper handling becomes essential. Experts recommend depositing entire sale proceeds in single transactions. Retain all supporting documentation, including bills of sale, title transfer paperwork, and deposit receipts. These records establish legitimate sourcing for the funds. Should questions ever arise, paperwork answers them conclusively. Family financial gifts constitute another common scenario. Adult children frequently provide monetary support to aging parents. Medical expenses, home modifications, and general financial assistance prompt these transfers. Gift recipients owe no federal income tax on money received as gifts. However, cash gifts exceeding $10,000 require the same deposit considerations as any other large cash transaction. Attempting to structure gift deposits creates unnecessary risk. A simpler approach involves depositing entire gift amounts immediately. Request that gift givers provide brief written statements confirming the gift amount and date. These letters, combined with deposit receipts, establish clear provenance for the funds. Account consolidation after retirement or spousal death creates the third common scenario. Seniors frequently reorganize their financial holdings during major life transitions. Moving funds between institutions sometimes involves cash withdrawals and redeposits. Financial advisors strongly recommend avoiding cash transfers between banks entirely. Wire transfers and cashier's checks accomplish the same objective without triggering cash reporting considerations. Electronic fund movements create their own documentation trails. These methods eliminate any appearance of structuring while achieving legitimate financial objectives. Banking compliance requirements stem from federal anti-money laundering statutes. Financial institutions operate under strict legal obligations to monitor unusual cash activity. The systems performing this monitoring function automatically without human judgment calls. Automated surveillance does not consider customer age, employment history, or community standing. The software analyzes transaction patterns against known indicators of suspicious activity. A retired educator with 40 years of honorable service appears identical to any other customer in these systems. Numbers and patterns drive the analysis exclusively. Repeated deposits clustering just below $10,000 match structuring profiles regardless of depositor characteristics. The software cannot determine intent. It identifies patterns and generates alerts. Human compliance officers then review flagged activity, but by that point, documentation has already become crucial. Some retirees mistakenly believe that financial crime monitoring targets only actual criminals. This assumption proves dangerously incorrect. Reporting requirements apply universally across all customer demographics. Federal law contains no exemptions based on age, retirement status, or career history. A 72-year-old grandmother faces identical requirements as a 30-year-old entrepreneur. Equally important, however, retirees should not develop excessive fear of cash transactions. Depositing amounts exceeding $10,000 remains completely legal. The reporting mechanism documents transactions without implying wrongdoing. Properly handling large cash deposits requires neither anxiety nor elaborate avoidance strategies. The genuine danger emerges when misunderstanding prompts counterproductive behavior. Attempting to avoid routine reporting through deposit splitting creates legal exposure where none previously existed. Clean money becomes legally problematic through structuring, not through straightforward deposit. Financial institutions occasionally contact customers regarding unusual deposit patterns. Receiving such inquiries should not trigger panic. The appropriate response involves calm, documented explanation. Provide relevant paperwork, including sales receipts, gift letters, or account statements showing fund origins. Answer specific questions directly without volunteering extraneous information. Documentation resolves these inquiries efficiently. Maintaining organized records provides the strongest protection available to retirees handling cash. Paper trails answer questions before they escalate into formal investigations. Receipts, letters, and bank statements telling consistent stories eliminate ambiguity. Taxation considerations generate additional confusion among retirees handling large cash amounts. Currency transaction reports do not automatically initiate Internal Revenue Service audits. These reports file with financial crimes enforcement agencies, not tax authorities. The filing of transaction reports creates no independent tax liability. Tax obligations depend entirely on whether underlying transactions carry tax consequences. Selling property at a profit may generate taxable gains. Receiving monetary gifts typically creates no tax liability for recipients. Cash reporting operates separately from income reporting, though documentation should support consistent narratives across both systems. When deposit records align with tax return information, no inconsistencies exist for investigators to question. Selling a vehicle for $15,000, depositing that amount, and reporting the transaction appropriately on tax filings presents a coherent picture that invites no scrutiny. Another persistent misconception involves visibility of deposits below reporting thresholds. Many Americans believe that transactions under $10,000 remain invisible to monitoring systems. Contemporary banking surveillance operates with far greater sophistication than simple dollar cutoffs. Pattern analysis examines customer behavior over weeks and months. Multiple transactions, even those separated by significant time intervals, undergo collective evaluation. Attempting to remain beneath $10,000 through repeated deposits actually increases visibility rather than reducing it. A single deposit exceeding the threshold attracts far less attention than multiple deposits appearing calculated to avoid it. Practical guidance for retirees distills into straightforward principles. Deposit legitimate cash in complete amounts without artificial division. Maintain documentation, establishing fund origins. Preserve receipts, statements, and relevant correspondence. When moving substantial sums between financial institutions, utilize electronic transfer methods rather than physical cash. Consulting qualified professionals before executing unusual transactions prevents complications. Certified public accountants and licensed financial advisors can evaluate specific situations and recommend appropriate approaches. Brief professional consultations often prevent years of unnecessary difficulty. The fundamental reason that $9,900 can generate more scrutiny than $11,000 relates entirely to inferred intent. Single large deposits triggering automatic reports appear routine because they are routine. Deposit patterns suggesting deliberate threshold avoidance appear suspicious because they match structuring profiles. Understanding this distinction transforms how retirees approach cash transactions. Fear dissipates when knowledge replaces rumor. The federal reporting system was designed to detect serious financial crimes, not to entrap honest citizens managing legitimate savings. Problems arise when misunderstanding the system prompts attempts to circumvent it. Well-intentioned retirees following bad advice create suspicion that straightforward behavior would never have generated. The perceived solution becomes the actual problem. Retirees have worked entire careers building their savings. These funds deserve protection through intelligent handling rather than misguided evasion attempts. Transparency serves retirees far better than secrecy. Open deposits with supporting documentation create no legal exposure. Structured deposits attempting to avoid reporting create exactly the exposure that retirees fear. The reporting infrastructure functions automatically regardless of customer circumstances. Working with that system rather than against it produces consistently superior outcomes. $11,000 deposited openly becomes a database entry generating no concern. $9,900 deposited repeatedly in apparent threshold avoidance patterns can trigger investigations that honest depositors never anticipated. Knowledge eliminates unnecessary fear. Understanding federal cash reporting requirements empowers retirees to handle their finances confidently. Transparent transactions supported by organized documentation protect against complications. Avoiding structuring behavior, even inadvertent structuring, prevents the creation of problems that never needed to exist. That fundamental reality explains why financial experts consistently confirm that $9,900 often raises more red flags than $11,000 ever would.